The cost of capital for a project, as it says here, is the expected return on securities of equal risk as the project. So when we're trying to get the cost of capital, which is the discount rate that we use when we find NPV, you can think about it. The firm's got some cash that they can put into a project, and that project has a certain level of risk. By putting the money into that project, they're giving up the chance to invest in stocks and bonds that have the same level of risk as the project, and therefore they're giving up the opportunity to earn the return that's associated in the financial markets with that level of risk. So we view it as the cost of capital. By putting our money into the project, by putting the money into that, we're giving up the opportunity to put it in here in the stocks and bonds. And so that is the cost of capital. That's what we use as the discount rate when we're finding NPV. And so that's the appropriate discount rate when we're doing our analysis of projects, valuing assets, and doing that kind of analysis. There's a risk return trade off. We do not like risk. So, in order for investors, for firms, for anyone to be willing to bear risk, they want higher expected return. They want a greater reward, or potential reward, or expected reward. So, in order for us to put all this together, we need to understand risks, we need to understand returns, and we need to understand how they're related in order to come up with cost of capital, because we need to get the appropriate expected returns, discount rates for various elements. So in order to evaluate the risk return trade-off, in order to find the appropriate cost of capital, in order to find the appropriate expected return, we need to understand things more. So a review on total dollar return. Remember, total dollar return captures your change in wealth in terms of dollars associated with a particular asset. And there's two components of that. The first is the cash flows from the investment. So if it's a stock, it pays dividends. If it's a bond, it pays coupons, or it may pay those. But that is if they're going to pay cash, those are the forms. If it's a piece of real estate, kind of rent after all the expenses and everything, can produce cash flow. The second is the change in value of the investment, which is the capital gain, and it's the ending value minus the initial value. So if I had a stock that went from $10 to 11, then I'm at +1, nice capital gain. If it went from 10 to 9, I'm at -1. I want to take that into account. Add the two up, and that's your total dollar return. Percentage return captures essentially the total dollar return, but we want to scale it. And so, actually up here, total dollar return, and we want to scale it. And what do we scale it by? The initial value. So if you view it as a timeline, and we have the total dollar return, over the whole period, which in this class we have take place at the end of the period, we scale it by the value of the particular asset or the particular investment at the beginning of the period. If you want to get the total dollar return and you have the initial value and the percentage return, you can multiply those and get the total dollar return. So for example, if we had a stock that was valued at $100, it had a percentage return of 10%, multiply those, and you can see that the total dollar return would be $10. So it's a way to back out the total dollar return from the initial value and the percentage return. And remember that total dollar return, those $10, they come from both the cash flow and the capital gain. So if you know one, you can figure out the other and use it to find out what the price was, will be, a lot of different things. A couple of notes: when you see the terms rate of return or rate of return, it's the percentage return. The only time it's the dollar return is if it explicitly says dollar return. If that word's not there, if it's not telling you that it is measured in terms of dollars, it's the percentage return, the return we've been dealing with the vast majority of this course. Expected rate of return, expected total dollar return, it's the same concept as total dollar return, except the expected means that we're looking at a time frame where not everything is known, and so therefore we use our best guess, we use what we expect, but we still incorporate it the same way. So the expected total dollar return is the sum of the expected cash flows plus the expected change in the value. That gives us the expected total dollar return. So we may not know what the dividend, let's say, is going to be because it's going to be paid sometime in the future. What do we expect it to be? We don't know what the change in the value is going to be with certainty. What do we expect it to be? And that's the expected total dollar return. Expected percentage return, again, the same idea. You've got a period of time, the expected total dollar return divided by what we expect the value to be at the beginning of the period.